Hello, everyone, and welcome to our Monday briefing series dedicated to steel. I'm your host, Neil Kumar. Today, up to 7 premium speakers will speak for 7 minutes about the latest news concerning steel. During this virtual event, experts will present a 7-day market review on the challenges and opportunities faced by the industry. This series is part of MMSteelClub's events. Check out MMSteelClub.com for more information. When we look at what is happening in the world today, there are still concerns over the vaccine rollouts across the world. Here in Canada, there will not be any shipments of Pfizer this week. Canada is trailing many countries when it comes to the speed of the vaccine rollout. Israel continues to lead on that front. Also, another significant event today is the articles of impeachment against former U.S. President Donald Trump that are now set to go before the Senate in Washington, D.C. tonight. With that, we will now introduce our speakers for today, which include Ashish K. Mahapatro, Jagdish Singh Walia, Marco Marconi, Amit Soibas, Rubens Yamawaki, and Somanath Tripathi. Our first speaker is Ashish K. Mahapatro, Vice President of Synergy Capital. He joins us from Dubai. Over to you now, Ashish. The floor is all yours.
Good morning, good afternoon, good evening. And since this is a worldwide session, so good day to everybody. And I welcome all the panelists, all the viewers to view this and to have a chat with us for their views as well. Coming back to the world, the last week we saw the market started after gaining a few weeks of momentum since starting November end of 2020. This market started softening since last 2 weeks. And whether we will say it is a price decrease or whether it is a price correction. Basically, if we look at it, we cannot say it is a price decrease or sliding. It is basically a price correction, which is needed for the time being. The reason is the price which has increased mostly because of the logistic issues, supply demand issues, the mills which has not yet ramped up, or the local regional mills which has not yet produced, unable to produce because of the COVID, and all these factors accumulated and provided us a platform to raise the price and gain the market as if there is a huge demand. So I will take you to first the slide of ferroscrap and billet. Now, if we look at it, the ferroscrap has increased quite significantly in almost in a month, $100 plus. And after that, similarly, the billet followed it, the semi-finished. And now, since last 2 weeks, both the commodities started weakening. And basically, the prices of scrap has fallen significantly compared to the billet. I think that will going to follow, billet is going to follow. So if we look at it, a drop of $50 already we have experienced in last 1 week, the scrap prices, whereas the billet has only dropped by $20 to $25. So definitely this is a signal of price corrections, but nothing to be panicked. The reason is we are seeing a price correction, but we are also seeing there is a demand and consumption is standstill and the consumption is improving basically. So what we have to take it away is like, even if the prices started falling, people have to see that their productions and logistics are arranged properly so that they can meet the production. And at the same time, the prices which has gone up, whether it is a real price or whether it need to correct to come back to its equilibrium position. So if we look at the historical, that is why I have depicted here the historical graph. If you look at it, the normal level or equilibrium level spread between billet to scrap is around $135 to $140. Whenever there is a above that or below that, means whenever there is a contraction or whenever there is a widen the gap, then it needs to come to the equilibrium state. So if you look at it in the week of December, if you look at it, the spread has came down to $113, $110. So that is where the market need a equilibrium, and where we are seeing that those equilibriums again either by stretching the prices or by the supply and demand. So in both way, if we look at it, now the prices again come down to the spread is becoming $140, which is the equilibrium line, which is made in the dotted line. If you look at it, that is the equilibrium. So whenever those prices or the spreads goes beyond the equilibrium to a certain extent or goes below the equilibrium to a certain extent, then there is a stretching or a tug of war between buyer and seller to bring down to that level so the market maintain a equilibrium. Next slide, please. Thank you. Now coming back to HRC, and we have seen that HRC also gained quite significantly during last 2 months. And in fact, I think this is one of the highest HRC prices after 2011. So if we look at it, the iron ore prices, again, it is also the similar high level, last 9 years high. And the good part is that at that level, iron ore is still sustaining for a quite longer period. If we look at it last 30 days or last 45 days, the iron ore is trading at more than $160. So which is quite significant amount. And we have not seen in those levels in last 9 years. And in fact, if we look at the history and take out the 2011 prices, the prices was not sustained at that level, which is $186 or so. It has never sustained. It has came down sharply after only a few weeks. So, but here we are seeing that the fundamental is quite strong, and the fundamental of iron ore especially is going on and on and on, and the momentum they are keeping up, and the price is sustained. We have also seen that iron ore is, China has imported iron ore almost 7 to 8% higher compared to their previous highest in 2019. So whether those momentum is going to be maintained by the Chinese, then definitely we are going to see the prices at this level. But what about HRC? HRC has its own dynamism. Now HRC prices has gone up because there is a scarcity in demand. Where is the demand came from, and why the demand came from? The demand basically came from countries where their own captive plants are unable to produce or meet the demand. But currently we have seen many news that ArcelorMittal Spain started, ArcelorMittal South Africa started, European plants started. So all these plants when started, they will meet the local demand. And whether that trade flow is going to remain the same or whether there will be a change in trade flow, the answer is to this is basically that trade flow is going to have its own impact, and the flow direction is going to change. And whether that will affect the prices, yes, definitely that will affect the prices. The prices which we saw that a spot or a spike increase, that will definitely not going to be sustained. The prices has to come down to its natural level. Natural level for HRC at this level is normally at 600 to 650 CFR. That is Vietnam, which is the largest buyer of HRC in the world, or the largest consumer of import HRC in the world. Now, coming back to the prices, we have seen last week the prices of HRC in Vietnam has fallen, and it is mostly because of the traders who has hold the position cargo and they sold out to just unwind their inventory or just clear their inventory before the Chinese New Year, because Chinese New Year definitely has got an impact on that trade flow, and everybody wanted to unwind their inventory and get rid of it before the Chinese New Year, because the dynamics of the trade or the commodity certainly affect always after the Chinese New Year, whether it is in the downtrend or whether it is in the uptrend. But considering the current market situation, where the prices are at high level or highest level in last 9 years, definitely the prices of Chinese after the Lunar New Year is going to have a bit of downward direction, but not looking at any upward direction. I will just say that to this logic, I will just say that because all the industries, all the countries now geared up to have their own captive productions, so which will have a normal level of availability of the material, and that will definitely require to consume own material, and that will create a kind of a surplus, that is going to create a kind of a surplus, and which will definitely help us in reducing the price rather than a increase. Now, coming back to Indian HRC, yes, domestic market is quite strong. All Indian mills are enjoying a nice price since last 1 quarter, and also they are exporting. That is also they are enjoying the price. But last week, the Indian domestic market also started to unsign their sales. So the prices has reduced by 1,000 to 1,500 INR, which is equivalent to $14 to $20 in between that range, depending on the various regions. But Indian HRC are still acceptable at a higher price in Europe. So this is a good sign, but whether that sign is going to sustain, again, we have to wait the time till the regional mills ramp up their production to meet the captive requirement. So coking coal, yes, which has lost its sign in 2020, basically. If we look at it, the 2020 is not a good year for the coking coal miners. But at least in last 2 weeks, they started gaining, and they started gaining quite abruptly by $35. So which is a 30% jump in 2 weeks. And last week itself, they have gained by $90, around $14, $15. So that is a good sign for the coking coal miners as well as the exporters. And if we look at it, the coking coal strengthening came up basically because of there is not a kind of a demand, but the environment, which in the Queensland, which is there is some disruptive environment things coming up, which is because of that they are finding that. Now coming back to scrap and billet, there is a pig iron. We have to see that the pig iron prices has gone up almost to 600 level, and if we look at it, the billet prices and pig iron prices at one time are the same level, which is never the case. So now either the pig iron has to come down or the billet has to go up. Since the scrap has came down, so pig iron has no choice, but they also have to came down. So pig iron also reduced by almost $40 to $50 during the last week. And the CIS pig iron basically started selling, which they used to offer 600 FOB in previous week. Previous week. So last week they started selling at 550 FOB. And definitely by looking at 550 FOB, which is still higher because the spread between billet and pig iron is only $25, and which is cannot be acceptable by a standard mill. So people will tend to buy more scrap unless they require some special grades. But at the same time, since the scrap and billet pig iron prices has gone beyond also their natural level, which is normally used to be like $40 to $50, and it has gone to beyond $200+ like billet. So people will tend to buy more scrap than pig iron. And the normal pig iron and the scrap advantage, pig iron advantage is not more than $30 to $35 at current scrap price level. So on TCO basis, pig iron always used to be like 8% higher if we compare scrap and pig iron. So this is going to be a challenge for the pig iron producer or the merchant pig iron producers who normally sells to the or export. So if scrap is coming down, then pig iron will definitely has to follow to some extent. Of course, the iron ore is still tanking at a higher level. So we are going to see a different dynamics, flow dynamics, as well as the price dynamics, flow corrections, as well as the price corrections in the coming weeks. Chinese New Year is 2 weeks away, but definitely people are now more cautious about their buying because the captive plants started, and that is going to bring a bigger impact to the market dynamics than anything other than that. So thank you very much. I wish all others panelists to raise their questions if they have, as well as the viewers. Thank you very much.
Thank you, Connie, for that presentation, Ashish. Just a reminder that this event is being streamed live on LinkedIn and on our website at MMSteelClub.com. Also, we are now officially streaming live on YouTube. Next up is Jagdish Singh Walia. He is the Vice President of Global Procurement and Operations at EU Metal BV. He is in Belgium today. Over to you, Jagdish.
A very good morning, afternoon, and evening to all of you, depending on your time zone. Thank you all for finding time from your busy schedule to join the webinar. And thank you, Steel and Neil team, for giving me the opportunity to the speakership. I'm Jagdish from EU Metal Belgium, looking after global procurement operations for the company. Today, I'm here to speak on the topic, latest industry insight on flat steel production in European region. Before that, a disclaimer, dear friends, much of the information, facts and figures mentioned in the presentation is transcribed directly from different sources and do not take any liability about the completeness, reliability, and accuracy of the same. And if I need to speak on the topic, I believe for flat, I should be speaking on the recent HRC price change. And could you put me to the previous slide, please? Yeah, the safeguards and anti-dumping, production cuts, delivery time in automotive industry, and last, European flat steel industry outlook. And can you take me to the next slide, please? Next slide, please. Before I start to speak on the topic, let me give you a brief on my company. EU Metal was founded in 2012 on a small level, and we are currently handling 300,000 tons every year of flat, rolled, long, round, and carbon and stainless steels, ferrous and non-ferrous scraps and wood products in more than 50 countries. We are having representatives in more than 30 countries. We are associated with world top 70 plus steel mills, having 11 warehouses in Europe, 1 in Canada and 1 in the USA. And the good news is company business grew 300 times in the last few years. Next slide, please. Next slide, please. Yeah, I will be talking about the recent HRC price change. Prices for the domestic steel, hot rolled coil, increase in Europe in the last week, ended Friday, Jan 15, due to limited availability of the material. Domestic exports, Northern Europe HRC at €716, which is roughly $865 per ton on Friday, up by 48.50 euro ton week on week and 79.75 per ton on month. Italian buyers on the southern side had made a few deals at 700 per ton exports. Domestic prices for flat steel products increased dramatically in the second half of 2020, which we all know. And the main drivers being shortage of both domestic and imported steel products after demand started to recover. Availability import has also been limited due to trade protection measures in place combined with a global price recovery. Traditional non-European Union suppliers prefer to divert material to alternative markets because all the prices in the recovered growth was slower compared with other regions. Next slide, please. Let me talk about the safeguards and anti-dumping. Last year, the European Commission replaced yearly country-specific quotas with quarterly ones, especially in hot rolled coils. This change left independent Europe buyers with fewer sources of overseas material, forcing them to turn to domestic suppliers. Hot rolled coil is already protected in the EU market by dumping duties. China, Russia, Ukraine, Iran, and Brazil have existing definite duties. The Commission has opened a review that could see duties on one Russian mill rise further. Turkey is already subject to provisional anti-dumping duties as well as an anti-subsidy case. This month, the European Commission set provisional anti-dumping duties at 4.8 to 7.6% on HRC originating from Turkey, which is one of the main suppliers to the European market. Next slide, please. Talking about production cuts, although producers started to announce restarts of their idle furnaces in October, November, that is autumn in Europe in 2020, this did not immediately ease a shortage of flat steel in Europe. In Germany, for example, blast furnace production in the January-November 2020 period trailed 2019 output by 15%. It may be estimated that production should increase further in the first quarter, second quarter of 2021 as restarting blast furnaces and achieving normal production rates takes over 2 to 3 months. Next slide, please. Talking about delivery time, because of reduced domestic production and a limited availability of imported material, delivery times have lengthened significantly. Coil producers in both the north and south of the Europe sold out of first quarter rolling coil in October 2020 and have been offering second quarter production material since then. Delivery time, however, is likely to shorten when utilization rates increase and the backlog of demand from the automotive industry eases. Next slide, please. When we talk about flat steel, we should be talking about automotive industry. Strong demand from the automotive segment was one of the key factors behind domestic oil price rises across Europe. High buying activity from car manufacturers was mainly driven by a backlog of demand after most car production was stopped during the lockdown. As a result, demand will soon moderate. Long-term contracts settled in the fourth quarter of 2020 were reported at about 100 to 200 euro per ton below current spot prices. In addition, long-term buyers have been complaining that they have been struggling to get agreed volumes from mills. This situation prompted concerns among some market sources that mills could break long-term contracts, which is what happened in 2008 when domestic prices rose rapidly. However, many believe producers could switch to short-term contracts in the future. Next slide, please. To sum up, talking about European flat steel industry outlook. While price corrections are indeed expected, healthy underlying demand will support the markets at historical high levels over the year. The European Commission is being pushed by 12 member states to review the existing steel safeguard that is due to lapse in June 2021. Demand should remain strong this year, supported by an expected expansion in output at all major steel consumers such as automotive, domestic appliances, and metal goods. Many buyers have covered demand until July and are going to just lean back and wait and see. Feeling is that this rally is short-lived and will last at maximum until end of second quarter delivery. Once supply and demand are in balance again, prices will go up. Thank you so much, gentlemen.
Okay, thank you so much for that presentation. Our third speaker is Marco Marconi. He is a steel industry consultant. Over to you now, Marco.
Hello, good morning and good afternoon to everybody. So please start with the presentation. Okay, so I will present the Italian market situation. Next slide. You know what you saw what I was doing. I'm a mechanical engineer with a master in general management in Bocconi, and I work all the life in the steel industry, mainly in ThyssenKrupp, especially Terni, the global key account in household application. 2 years in Yuzhong, and I was CEO of Ironspa in 2019 up to 2020. The Ironspa is a service center for HRC processing located in Assisi. So, next slide, please. What we discuss now, the price development, the local mill situation, the availability or not availability in the market shortage, and the reason behind this price increase and what we can expect for the future. Next slide, please. Price development. So I show here, we can see the price development in the past 10 years with the indication of the main market, Turkey, Italy, Russia, and China. We can see that the price are at the maximum level since 10 years. Next slide, please. Next slide, please. Okay. So for the availability point, the mills are fully booked until end of Q2 2021. We have an increase, dramatic increase in the lead time, so 20 weeks versus the normal 10 weeks lead time. So we order at a very high price and we even don't have the material. With a focus on the Italian market and the Italian mills, we have the ILVA, which forecast in 2021 5 million tons production, but after the restarting of a blast furnace that is foreseen for February 2021. We need to focus that in the entrance in the public company in Italia, in ILVA, it's subordinate to the approval, to the green light from the EU. Arvedi also is a very strict on the budget, limited quantity to the market, and we have and focus mainly in their service center. So we have no import from Turkey and Korea. The mills are increasing the production indeed, but this increase is foreseen in the coming months. We will expect tight availability of steel supply, and it will last at least up to first half of 2021. Other question mark is the safeguard that will be confirmed. Please, the next slide. So, what is the question, the main question for the service center? To buy or not to buy? The service center are worried to buy material at this level of price, fearing a drop of price in the coming months. So they are reducing the purchase and they buy only to cover spot orders. And the situation here in Italy, but almost in every part of Europe, is that apart from very few of them, there is no stock and no material in the market, even to fulfill already agreed contract agreements. In this moment, the main problem in the market is to find material more than to get 10 or 20 euro discount. And users are struggling to receive and to find material, not to stop their factories. And also we are facing that many mills are already cancelling agreed frame contracts in terms of volume, in terms of price, and also rediscussing agreed price for spot orders. Next slide, please. So what is behind this cost increase? And in the opinion of everybody, the price is sustained by the lack of offers more than a real increase of demands. In fact, there is a raw material increase that can justify a cost increase, as you can see in this graph. But in any case, we need to consider that the margin also of the steel mills are increased versus, for example, July 2020. We also have offer and production disruption due to accident in Europe, in Korea, in Russia. And also we have some demand from automotive and home appliance, but we will check more in detail in the next slide. During the COVID, the situation is that the mills, sorry, the previous slide, I didn't finish yet. Previous slide. Okay, perfect. So during the COVID-19, the mills canceled 30% of production, and this capacity still is not yet recovered. So now next slide. Next slide. Okay. So we have a similar situation compared to 2008, but at that time there was a demand increase behind that increase of price. In this case, there is no real economy increase that is supporting this level of price. As you can see also in some news that, for example, FCA had a drop of 26% of sales of cars last year. Also, the expectation of GDP for the next year are not good. So we lost almost 9%, more than 9% in 2020, and the forecast is to return to a pre-COVID level only on 2023, according to Banca d'Italia. Finally, we need to see and check that in Italy, there is, for a government, the layoff are on hold until end of March 2021. So even if the governments are considering to extend this prohibition, everybody is foreseeing dramatic increase of layoff of people after this period. So the question is not if, but when the bubble will explode. Thank you.
Thank you so much for those insights with that great presentation, Marco. Just a reminder that this event is being streamed live on LinkedIn and on our website at MMSteelClub.com. Also, we are now officially streaming live on YouTube. Next up, we have Ahmet Soybas, Vice President at Sami Soybas Steel Industry and Trade Incorporated. He's in Istanbul, Turkey today. Over to you now, Ahmet.
Hello, everyone. This is Ahmet Soybas. I'm Vice President of Soybas Steel Company. First of all, I want to thank MMSteelClub for their kind invitation for today's webinar. Let me give you a quick introduction about our company. Next slide, please. Soybas Steel, founded in 1961, is one of the oldest steel trading and storage company in Turkey. Besides local steel distribution, we produce steel tubes and hollow sections. Also, we have a steel service center with cut length and slitting lines. Also, we export all types of flat and long and tubular steel products to our customers worldwide. Next slide, please. Today, I want to talk mainly on flat steel prices in the last 7 days. But to do so, I want to give a quick flashback of what had happened in 2020 and why it happened. When I look at the steel prices in the last 20 years, I figure out that second half of 2020 was similar to the post-2008 crisis times. The price chart shows scrap and HRC prices in Turkey between 2005 and 2021. In the first half of 2020, like in the 2008 crisis, demand and supply was both down due to the coronavirus. After summer, steel demand started increasing faster than the steel production, thanks to decreasing restrictions and a huge monetary expansion all around the world, and this caused a big increase in steel prices. Also in 2010 and 11, we had seen similar impact of monetary expansions and Turkish HRC had gone up to $820, and scrap had increased to $510 CFR Turkey. These were the highest after the 2008 prices. Prices had kept high until 2014, when Fed had announced the end of the monetary expansion, and China had started offering huge quantities of steel to export markets. Next slide, please. Now let's come back to this week. After all, steel prices all around the world increased in 2020 Q4. In January 2021, we saw some price declines in China. The reason for this was Chinese traders trying to empty their positions because of approaching Chinese New Year, like they almost did each year. The price charts show the HRC futures prices in Shanghai Future Exchange. When we look at the prices in the charts, we can see that almost each year we see some price decrease in China before Chinese New Year holidays, and after the holiday, prices start increasing again. This is what I expect for this year as well. There are several reasons that make me think this way. First of all, as other speakers informed, there is a big shortage of ready stock material all around the world, and mills are fully booked minimum 3 months. Turkish mills have mostly closed April production sales, and they are not in a hurry to offer for May production. And there's a huge amount of money in the world. Moreover, Joe Biden announced that he will give another $1.9 trillion monetary expansion, which will total the USA expansion to $10 trillion. Please remember, in 2008, there was only $4 trillion saving packages, but this time we are reaching $10 trillion. I want to give some information about HRC prices, current prices. Turkish mills HRC prices are around $820 ex-workspace. And prices in Europe and USA are also strong. HRC in Europe is almost $850 up to $900, and in USA around $1,300. Also in Japan and Korea, HRC prices are strong at around $800. Only in China, there's some shortage due to the New Year, and mainstream mills are offering at around $690 up to $700 FOB. Positional cargoes are heard at around 640, 650 FOB levels, but we understand from suppliers that the availability of these cargoes are limited, and these offers are also for April shipment. Finally, one of the most important things that supports the prices is that will support the prices is that corona vaccination has started, and if things go well as expected, we hope to see easing of corona in 2 to 3 months' time, which is going to bring a big demand from various sectors. If this will be the case, we might see even higher prices in the 2021 Q2. Here I'm ending my speech, and I thank you all for listening. I'll be glad to reply your questions. Thank you very much.
Okay, thank you so much for that presentation. It was well done. Next, we have Ruben Yamawaki. He is the slab sales manager at CSP. The floor is yours now, Ruben.
Thank you very much. Thank you very much, all. Good morning, good afternoon, good evening to everyone. First of all, let me introduce a little bit about the CSP, which is one of the main players of the slab merchant market and the most modern mill of the Americas, producing and selling 3 million tons per year at the highest standards of quality worldwide. So I'm going to speak a little bit about the slab merchant market and the slab merchant, the current market, how it is. And as any other commodity, conceptually, the steel prices are determined by the next best alternative. That means that if a certain player price should be at least not higher than the second best alternative of its competitor. Of course, there is also always a premium over the reference, depending on delivery time, service, and relationship level, these things. But theoretically, what I'm trying to say is that the slab prices, it depends on the scenario of supply and demand. But most of the time, the supply side is higher than demand side. And on that scenario, the prices are usually based on the cost. In other words, the price charged are limited by the lowest part of the cost curve. Of course, this is not a wide known information. So the market regulates itself considering the expected price, and sometimes we will prefer to sell below its cost depending on to keep their operation without stopping their very expensive blast furnace, this is kind of an extreme decision. But since after the hardest stage of the pandemic, the demand has been much higher than the supply actually. And at this scenario, the prices are not driven by cost anymore. This is actually driven by market opportunity. So in this sense, the seller, they aim to book their order at the highest price and desirable timing. So if the market can pay a higher price based on their expected margins, the seller will charge based on that. So the buyer, aiming for finding the best alternative at the cheapest price possible, but at this volatile moment, which we are living right now, and at this very uncertain level as well, it is very hard to understand what is the right price and what is the right time. So in this case, sellers have a good moment and can share the profit of the finished product market as well. So what is the root cause of this situation, of this unbalanced situation of the COVID-19 pandemic? Actually, this COVID, this drove us to a totally unexpected situation. Nobody knew what was about to happen. So this situation forced so many companies to shut down their non-competitive operations, and that includes the blast furnace, which are not very cost efficient, and also the supply chain has kept as long as possible the wait and see position, and that lasts until their inventory level drops to a historical lowest. So after the pandemic, when the markets reopened after this apparent control of the pandemic, the demand picked up so quickly, and to rebalance this inventory level, well, the production pace of the supply chain is not balanced at all. Since the blast furnace, they take much longer to recover their production pace compared to the downstream. So under this situation, things run very fast. And also it was supported by the lack of working force, which was laid off or fired, which impacted the operational situation of many mills around the globe. And that, as we can observe these days, has also caused many failures on the different mills. And for the blast furnace side, those failures that just support the idea of market prices keep going up. So actually, this reason that I just mentioned, this is not expected to change anytime soon. So we'll keep seeing the volatility since the COVID-19 is still uncertain, because that we are also already seeing that the virus can mutate, and that can affect again the global markets. And we don't know how it's going to be the real shape of the global economy. in that sense, that will keep supporting the prices volatility worldwide. So that is making companies to be very cautious to decide whether to restart many of those blast furnaces, which are not very competitive. And apparently, the answer so far is still no. So from the current markets, the current workable prices of slabs from Brazil are at the range of 760, 780. So it's a $20 range. And as you know, the slab availability is very limited at this moment. And the finished product prices at the Americas specifically, which is the key market for the Brazilian slabs, is ranging from $1,000 to $1,200, which is a very good margin for the current slab price. And regarding the Section 232 in the United States, which is I would say the hottest topic for deciding this price level for Brazil compared to the CIS, is actually in better shape than when the market was anticipating with the Biden winning the elections in the United States. So mills are very confident that it will keep for 2021 as well. And regarding the quota of Q1 2021, it is still in good shape, and it is actually, there's more room than it was anticipated. So that is making the buyers in the United States much more comfortable to purchase slabs. And even if the slabs are arriving in the United States in April, which is after the day one of the Q2 quota. And those things are all very positive to keep a good price level from Brazil. Of course, there was a correction of some of the raw materials, as other speakers already mentioned. Iron ore, scrap prices, they had this correction. Also, the CIS slab prices have been corrected. But it is important to remember that by end of September until early November, the prices of CIS was also dropping. And they dropped around $30 per metric ton. But from November, there was a strong rebound, and there was a sharp increase of $260 per metric ton until these days. So, of course, it is very hard to foresee what is going to come next. But all these things considered, we believe that the market will be keep increasing from the current level until the past few months. We don't know how much that will sustain, but still looks in good shape for the short term. That's it from my side. Thank you. If you have any questions, let me know.
Okay, thank you for that presentation from Rubens, who is in Brazil today. Our final speaker for today is Somanath Tripathi. He is the Chief General Manager of Materials Management of the Raw Material Division at Steel Authority of India Limited. He is joining us from Calcutta, India today. Over to you, Somanath.
Yeah, good evening. Thank you, MMSteelClub, for inviting me to speak. I want to speak on recent reforms in coal sector, which will contribute to making Indian iron and steel industry very competitive. As it is not possible to cover all the details in a short time, I plan to cover detailed analysis of its impact on iron and steel industry in next session if possible. Shall cover the reforms chronologically, starting from 14. Slide, please. Is it possible? Or I have to... Okay. See, it's now reforms in coal sector. We need by 2030 as per National Steel Policy 2017, for 300 million ton of crude steel, coking coal around 180 million ton, non-coking coal for PCI 35 million ton, and non-coking coal requirement for DRI 82 million ton. And power requirement for the entire industry may be around 27,717 megawatt. So at present, 70% of our 70% of coking coal requirement of domestic steel industry is presently being met through imports. Non-coking coal we are taking from Coal India or Singareni Collieries Company, and post deallocation of coal blocks, some units are purchasing power at a very high cost. Despite world's fourth largest coal reserves, India imported around 235 million tons of coal last year, of which 135 million ton valued at around 1.71 lakh crore could have been met from domestic reserves. So if some of the major reforms that has been done post 2014, after 204 coal blocks were allocation of 204 coal blocks were cancelled by Supreme Court, then the Coal Mines Special Provisions Act 2015 was enacted. It basically cleared the way for transparent allocation of coal mines through auction. Then there was coal allocation monitoring system and online coal clearance system. Those initiatives were taken. Then for the first time in February 18, private firms were allowed for commercial coal mining through auction. But that time, this auction parameter was at fixed cost basis, like the bidders were supposed to give fixed rupees return for each ton of coal they will mine. Then there was one Uttam app for monitoring of coal given by CIL. Then in August 19, 100% FDI under automatic route for coal mining was permitted. Then in December 19, Coal Ministry simplified the process of mining plan approval from 90 days to 30 days. Then as there is a shortfall and it was realized that we have to allow more and more parties because our public sector undertaking like Coal India and SCCL were not able to meet all the requirements. So that Mineral Laws Amendment Act 2020 was enacted in March 20, which simplifies things a lot. It removed the restriction of end use of coal, relaxed eligibility criteria for auction of coal and lignite, completely doing away with prior experience of coal mining. Then it allowed composite license for prospecting and mining. Then transfer of statutory clearances to new bidders for a period of 2 years for keeping continuity of operation. Then state governments are empowered to take advanced action for initiating auction of mines rather, before expiry of the lease. Then commercial coal mining was launched, auction was launched on 18th of June 20. Then this to attract more bidders, instead of fixed revenue, revenue share basis was the criteria of this auction. Then there was incentives for excess and early production, also for liquefaction and gasification. So there were auction for 41 coal blocks, but 76 bids were received from 42 entities for 23 coal blocks. Then at that time, during this process, which was conducted by MSTC, 51 weeks were given to prospective bidders for making a mine fully operational for explored mines, fully explored mines. That was around 29 numbers out of 41, which was put for auctioning. And then out of these 6 were totally operational before their allocation was cancelled, and it was and therefore 6 to 9 months were given to make them fully operational because all the clearances were there. Then auction was conducted in November 20 from 2nd to 9th, and 19 coal blocks were successfully auctioned by MSTC. And and subsequently on 11 January 21, the contract with these successful bidders for 19 blocks was signed, and that was the first commercial coal mine auction. And that day, a single window clearance portal was launched, which was a unified platform that facilitates grant of 19 major clearances and approvals required for starting a coal mine in India. This will highly simplify the process and expedite operation of coal mines. So then, out of these 19 blocks, which will be very relevant to steel industry, this 2 coking coal mines, one in Jharkhand and one in Madhya Pradesh, have been allotted. And then when this outcome of all those commercial coal mining and all those opening of coal sector will be, some steel companies will focus on their core business while procuring coal for professional miners. And when all these mines will be operational, there will be wide availability of coal, which will bring down the costs of various items for steel industry, like power, coal itself, coking coal, non-coking coal, and finally other items like various imports, which depend on this coal. Then this will definitely make Indian iron and steel industry globally competitive. And then further, there are other reforms proposed, like opening up the marketing of the coal, such that these buyers are provided coal. They are assured the supply of coal and faster. And for that, all the steps are getting initiated, and the next tranche of coal mining auction is planned in January itself, January 21. So this will be the starting, and this 13th of this month, the cabinet has already approved further streamlining of major reforms, streamlining of operations and major reforms in mining sector other than coal mines, and this will give further impetus to reform process and make Indian iron and steel industry more competitive. Thank you.
Okay, thank you so much for that presentation. For those of you who joined the interactive webinar platform, you can now use the panel to ask your questions. Before we head into the Q&A session, we have something special for you. MMSteelClub will be giving away 3.999 fine silver coins to those who share our video highlights on LinkedIn. We'll organize a draw and 3 lucky winners will receive the silver coins. Winners will be announced during the last week of every month, so stay tuned. Our video highlights will be posted daily, so don't forget to share. Just a reminder that this event is being streamed live on LinkedIn and on our website at mmsteelclub.com. Also, we are now officially streaming live on YouTube. We will now enter the Q&A session. The first question is for Somanath Tripathi. Due to rising steel prices, will government-funded projects in India start using steel alternatives? Somanath?
Yeah. Again, please.
I'll ask you the question again.
Yeah.
Due to rising steel prices, will government-funded projects in India start using steel alternatives?
Yeah, but it may come, but I'm not too sure like what will be the course of action. But all the prices are almost same level, all producers. So it wouldn't make a difference.
Okay, thank you. And will China's crude steel output this year, how will that do? We can ask you as well, Marco, that goes to you. Marco, if you can just unmute your microphone.
Okay.
Okay, great. Would you like me to ask you again?
Yeah, sure.
Yeah, will China reduce its crude steel output this year, and how will affect this the global markets?
As far as I understood and as far as I know, they will not reduce the output. The main point is that at least in the Italian and the European market, is the imports are really low compared to the last years. Last years we can buy material from any mills around the globe. So in this moment, instead, the imports are very limited. So it's is becoming a very close market in both steel and stainless steel production and consumption.
Okay, and Jagdish, can you give us your take on that? How will China reduce steel prices and offerings?
A lot will depend on, like how the imports take place in Europe and other countries, because, there are 3-4 things to, you have to understand. One, like a trade war is still on. Number 2, there are anti-dumping duties in many countries. There are import restrictions and so on and so forth. So a lot will depend on how the government will look into it. For example, for Europe, a 12-member committee is going to give their verdict in June. And on the realistic side, it says either they will make these rules removed or they will make it a bit lenient. So a lot will depend on all these things, and depending on that, you can have a take on whether they will increase or not increase. Secondly, the picture will be more clear after the new year, because this is a general trend every year. Like before the new year, China has the tendency to sell off their material, in the low prices, and then after that, they increases the prices. So a lot will depend what China is going to do after the new year, and the trade wars, and the whether the other countries increasing the capacities or not, whether the government have lenient policies when it comes to anti-dumping and other things, that will decide. So maybe the picture will be more clear when the prices stabilizes, maybe after the second quarter of this year, which I believe.
Okay, thank you. And this next question is for Ahmet. How are China's steel prices and offerings affecting domestic and export flat steel markets in Turkey?
Thank you very much. At the moment, it's not affecting. The Chinese trader prices have come down in the last maybe 2 weeks. But as Turkish mills are fully booked until almost May, they have plenty of time to wait. And I believe they will be waiting for the Chinese New Year holiday to end. And if after the holiday, if Chinese prices keep low, and if Russian CIS prices also come down due to the Chinese price, then Turkish prices might need to go down maybe in March. But until March, I don't think Turkish prices will be affected by the Chinese prices.
Okay, thank you, Ahmet. The next question is for Ashish. Is demand weak in the UAE and other Middle Eastern countries, and when can we expect a recovery in demand? Go ahead, Ashish.
Hi, Neil. Can you please repeat the question?
Yes. How is demand in the UAE and other Middle Eastern countries, and when can we expect a recovery in demand?
Look, on the recovery side, all the plants started producing. That is what I could see. And all the MENA region, basically, when I say MENA, is like all the GCC countries, especially. Saudi Arabia has already came up with new policies for improvement of their economy as well, and which is supporting the steel industry. In the UAE itself, the government has already allocated certain projects and funding them for the fund as well. They have already allocated. So moreover, I could see that the recovery has already started to have, but it will be a slow recovery. But by H2 2021, we will see again, the UAE market as well as the GCC market will come to their pre-COVID level. So that is what I could see at this moment. And the government is fully supportive on that, and they have started funding to many projects, which is then definitely it will improve the steel industry as a whole.
Okay, thank you. And the last question is for Rubens. Rubens, what factors are driving steel prices in Brazil?
Okay, thank you for the question, Neil. Well, I believe that in the case of Brazil, it's not that much different than other countries across the world. It is a matter of a supply and demand, right? I mean, as I mentioned in my presentation, after the pandemic, there was a very low inventory level of in the whole steel supply chain. So when the demand picked up, the players restarted to produce as much as possible, but still it is not enough. So actually this unbalance of the market is driving the prices as high as it is right now. And the prices in Brazil are lower than the North American, but not that much lower. So I would say it's basically a supply-demand situation.
Okay, thank you so much. And that concludes our Q&A session. Once again, I want to thank all of our speakers for contributing and making this session interesting. Ashish K. Mahapatro, Jagdish Singh Walia, Marco Morconi, Ahmet Sorbas, Rubens Yamawaki, and Somanath Tripathi. Attendees, thank you for tuning in. For MMSteelClub, I'm Neil Kumar, and we'll see you for the next episode of our 7-7 series.